basically a lot of countries are saying maybe we shouldn't have 100% of our reserves. Maybe we shouldn't have 80% of our reserves in dollars and treasuries because a handful of people in DC can just snap their fingers and seize those funds, or prevent us from accessing that whole ledger and making payments in dollars. And so there's a push by some countries to diversify their reserves. So either a couple different types of fiat currencies, or gold, for example. And then also to diversify their payment systems. So instead of being so reliant on SWIFT and having so many payments basically go through New York, they want to have, bridges between central banks and things like that in order to facilitate more non-dollar trade.
The agenda for the de-dollarization of the BRICS countries, including China, Russia, and the other BRICS countries, has been hotly contested and discussed over the past few months. Whether de-dollarization is occurring or can be permitted to occur in the United States, as well as whether it would be good for the country's economy in the long run, is a subject of debate among specialists in that country. Investors, however, do not appear to be overly concerned about this brewing storm at this time. There is little time to focus on events outside because of the Fed's ongoing interest rate increases, the recent regional banking crisis, and other internal dangers to the faltering economy. The untouchability of the US dollar and the nation's standing as a powerhouse are two more things that many US investors hold dear. Many people find it difficult to conceive a scenario in which the United States did not exercise complete dominance over the rest of the world because of its vast military and economic resources. The de-dollarization of the economy is a relatively new and strange concept to investors in this category that is being pushed by the press to create mass anxiety. Nevertheless, most experts concur that the trend away from the US dollar has been ongoing for roughly 20 years. As international central banks have continued to diversify into other fiat currencies and commodities like gold, the dollar proportion of reserve currency has gradually decreased since the early 2000s. Diversification was taking place, but it was only doing so subtly, not quickly enough for the typical investor to be concerned or even aware of it. Things changed dramatically last year after a flurry of financial and economic sanctions were announced against Russia for invading Ukraine. As a result of how quickly Russia was forced off the SWIFT system and its assets were seized, many countries were motivated to leave the highly centralized system before they were forced off and had their assets seized. Popular financial analyst and creator of the Lyn Alden investing strategy, Lyn Alden, spoke on the growing de-dollarization agenda and what it implies for the U.S. economy in a recent interview with The Jay Martin Show.
We don't see like rapid de-dollarization, but we kind of see like no longer increasing dollarization over the
Yeah,
past
okay.
number of years. And then,
Yeah.
this past year, you've seen a little bit more acceleration in de-dollarization. And I think there's kind of two big underlying foundations for that. So number one is that ever since the global financial crisis, and a few years after that, a number of countries decided that basically treasuries are probably not going to be very attractive, and they don't want to finance the U.S. government at negative real yields. So I mean, for much of the 2010s decade, for example, T-bills were yielding less than inflation.
Yeah.
Longer duration treasuries were yielding, roughly in line with CPI. It kind of varied over time, and they were underperforming, other assets like equities and real estate and things like that. And so a lot of these governments said we don't really want to, facilitate that. China in particular in 2013 said it's no longer in our interest to keep accumulating treasuries. They just come out with a statement. And so what China was at the time in the prior decade the biggest net buyer of treasuries. And so what China started to do instead, for example, is they started to use their dollar surpluses, their dollar trade surpluses, instead of funneling them back into the U.S. Treasury market. They started making loans. Say that the Belt and Road Initiative. They started doing kind of like what the IMF and World Bank do, on their own scale, where they go to countries in Africa or other countries in Asia or certain countries in Latin America or Eastern Europe, and they say, okay, we're going to provide dollar loans in order to build this, railway or this commodity development or this refinery. And so they found that to be a better use of their dollars than plowing them back into treasuries. You had other central banks, like say, the Swiss National Bank, plow it into U.S. equities, rather than U.S. treasuries. And the other ones, just, the dollar was pretty strong, especially, starting in 2014, 2015. And so many countries were just kind of not accumulating reserves and therefore just not accumulating much treasuries in general. You also saw from the 1970s until around 2009, there was this like net reduction in central banks holding of gold. Kind of it was like the slowly declining gold stash. But starting in 2009, you had like a V-shaped recovery where central banks began reaccumulating gold on net. And so they found that, to potentially be a better, reserve asset for them. So that's number one is basically the unattractiveness of treasuries that don't keep up with inflation, which is an environment we've been in. The other one is basically that the treasury and the dollar market in general is a permissioned ledger. So it's a ledger that, you can be cut off from. Your assets can be unilaterally seized. And, obviously it's not done arbitrarily, but, most countries around the world have had periods of time over the past, say, 50 years where they've not been in the good graces of Washington for one way or another. The severity can obviously differ. Sometimes it's like an outright war. Other times it's just, various agreements. Maybe the Treasury doesn't want India doing business with Russia, and India says, well, we're going to do business with Russia. And so India is not in the bad graces of Washington, but it's not maybe not the best graces of Washington. So basically, a lot of countries are saying maybe we shouldn't have 100% of our reserves. Maybe we shouldn't have 80% of our reserves in dollars and treasuries because a handful of people in DC can just snap their fingers and seize those funds or prevent us from accessing that whole ledger and making payments in dollars. And so there's a push by some countries to diversify their reserves. So either a couple different types of fiat currencies or gold, for example, and then also to diversify their payment systems. So instead of being so reliant on SWIFT and having so many payments basically go through New York, they want to have, bridges between central banks and things like that in order to facilitate more non-dollar trade so that they can't have their payment systems shut off either. So both as protection for their savings and payments on a permission ledger, they want to have basically an assortment of other payment and savings mechanisms to choose from. Yeah, I think they'd have more freedom with their reserves. They also might be able to hold less reserves because, nobody exactly, for example, wants to hold a lot of Chinese bonds. They don't want to have 50% of their central bank reserves in Chinese assets. It's got capital controls. It's not super attractive. But China, for example, is the largest trading partner with most countries in the world now. Over the past 20 years, they've surpassed the U.S. For most countries as their biggest trading partner. And so, with, let's say, China and Brazil trade, Brazil sends a lot of commodities to China, and China sends a lot of electronics and other products to Brazil. And so one thing they can do is just basically, like one of them gets a temporary surplus and it gets plowed back into the goods of the other one. You have that more circular payment system that doesn't really need to use the dollar. And they both might hold some degree of each other's reserves, with excess reserves maybe going over into gold or something like that. That's generally kind of a trend we're seeing. And so, while I don't think you'll see massive reserves, in these other types of countries, I think we're slowly seeing a diversification of reserves. I mean, Chinese holdings of Chinese, assets among global central banks over the past, say, 5 years went from virtually zero up to, you start to see countries doing 3, 4, 5% of their reserves in that. So it's a marginal change, which then we also combine with, gold increases. You have a little bit less focus on American and European assets as reserves and a little bit more focus on brics, gold, that kind of thing. People in the past, when they talk about prior global reserve currencies, they act as though there's just kind of a different reserve currency over time, which is partially true, but all those past ones were basically just proxies for gold. I mean, right. Central banks would hold gold. Sometimes they'd accept each other's, payment ledgers and bonds and things like that as gold proxies that are maybe more convenient and pay some interest. But essentially gold was at the center of the system. And since the 1970s, the Treasury kind of replaced gold as a key part of the system, which is that, instead of holding a gold proxy, all these central banks around the world will hold dollars and treasuries as usually their primary asset. And that system kind of reached its peak in the early 2000s. Um, and so I think we are starting to see a reversion to the mean where gold is becoming, a kind of regaining its kind of centrality among at least some countries' reserves. Um, and other things too, like, just basically loans to other countries that are kind of indirectly tied to hard assets, like loans to make infrastructure or commodity deposits or refining stuff. Sometimes that comes with a caveat that if those loans are defaulted on, then the rights of those assets get transferred to the lender. And so I think we're seeing a little bit more kind of hard asset, commodity, gold preference. The challenge, of course, is one, those types of things are less liquid. They can't be used for fast payments. And then also, the advantage of self-custody gold is that a country actually holds it, whereas a problem with those types of lending environments is if they're defaulted on, how do you enforce your property claims
Right.
in another country?
How do you feel about Lyn Alden's interview? Do you consider the BRICS alliance to be a strong rival to the US and the US dollar, along with its proposed common currency? Please share any thoughts or observations in the space below. In order to see more videos like this one, make sure you like this one, subscribe to the channel, and enable post alerts.